Well, good evening, everyone. We are going to get started here in a moment. The number of people entering the room is going up fast and furious. So we'll be with you in about 1 minute. We'll be starting in a moment. Okay, well, good evening, everyone. I'm Victor Minash, one of the partners here at Y Street Capital. Thank you for joining us tonight. We're here to be talking about a project in Ottawa, Canada called Westboro Tower, named after the neighborhood in which it resides. We've got several of our team also with us tonight, but I think the way this webinar is set up, it'll just be me on stage, and we'll be available to answer questions at the end. So I'll go through a little bit of a presentation, share with you what this project is all about, and we'll go from there. As always, there's with any offering, we're making forward-looking statements, which of course can change. They're accurate to the best of our knowledge, but there's always the usual disclaimers. So the fine print is here for you to read, as there would be in the prospectus, should you decide to look at the details and go a step further. I'd like you to think about this opportunity same way as we would evaluate any opportunity ourselves. When we conduct due diligence, we look at three elements. We look at the team, who's the team behind the project, the specific market and the submarket, and then we look at the project specifics. And I'd suggest that you do the same thing as well, because that's what we would do if we were evaluating an opportunity. And so we're actually going to touch on all three of these aspects. Let's start with the team. So who am I? I'm Victor Minash. I'm senior partner here at Y Street Capital, along with several other partners that I will introduce. The team as a whole, if I think about our daily staff meeting, we're about 13, 14 people on our average daily call. That's a mix of both partners, staff, and interns. We have, as a partner on this particular project, he's not partnered with us on every project, but he is on this one, Matt Picheni. He's based in New York City, famous for being a Tony Award-winning actor on Broadway. His wife is also a Tony Award winner and well known for shows like Moulin Rouge and several other Broadway shows. Matt has been in the world of real estate investing for quite a number of years. He's been an investor in over 10,000 units, of which he's been a general partner on about 4,000. We have Matt Maxim, who heads up, does a lot of investor relations work with us. He's very active also in project managing several of our projects. Also, he's a partner in the firm. Patrick Trahan, who is our lead underwriter, also one of the founders of the company. And Paul Hanchard, who joins us from the Canadian Air Force. He's been with us several years now, and he does a lot of our systems design, a lot of our due diligence, and a lot of the behind-the-scenes work. So if you have invested with us before, chances are you have also dealt with Paul. We also have as a partner on the project a gentleman who's very well known in the Ottawa area, a gentleman by the name of John Bassey, and he has built many of Ottawa's tallest towers, including the building across the street. So a 9-story building across the street. So we're very familiar with the area. He's built many buildings under the Soho brand for that particular developer. And then the picture you see on the bottom is a 3-tower complex that he is currently has underway. I think it's a 32, a 26, and a 24, something like that. But he's very active building, continuing to build in the Ottawa area, even though technically He's told his wife he's retired, but I don't think so. So he's very well known with an impeccable reputation in the Ottawa area. So the general partner team, we're very active. We have quite a few assets under management. We've been raising capital for multiple different projects. We are building apartments, senior housing, storage, flex multi-tenant industrial, and we do a lot of land development as well. We have over 2,000 acres of land in our current portfolio. So we're very active in 9 states across the U.S., and we have 4 or 5 projects that we are developing in Canada, some for ourselves and some also for third-party clients who have hired us as their in-house development team to build for them. This is an example. This is one project. This is actually by far our largest project in terms of acreage. It's 1,783 acres on the edge of Colorado Springs. Very, very interesting project. It's an entire master plan community that will eventually be more than 9,000 rooftops. Our immediate neighbor is Schriever Air Force Base, which is U.S. Space Command. So it's a very unique situation. In fact, all of our projects are unique situations where there's some reason why this project exists in this location. And this is one of them. This is a project that started out as a cattle ranch. It was originally owned by Mr. Norris, the Marlboro Man in the cigarette commercials. So if you ever remember seeing that face on a billboard, that's who owned this property originally. And so we're very thrilled about this project. We've already started the annexation petition into the city, and we've already submitted the complete master plan as part of that zoning overlay for this annexation. This is another example. This is a project that we built in Lake Charles, Louisiana. It's a residential assisted living facility. It won the Senior Housing News Architectural Design Award for the United States back in 2021. That project is doing spectacularly well. I mean, it's a great, great project. And we don't go into projects like this to win awards. We go in to do well and do good. This is one of those projects that is not just a piece of real estate, but a complete service offering. And so it's not just the bricks and mortar that makes for a great facility. It's all the staff, it's the training, it's all of those things that come together to create a great product for the community. What are we doing here? Why have I got this on my screen? Okay. And then for those of you that are based in the United States, you want to think a little bit about why even consider doing something outside your home market, or why would you even consider doing something outside the United States? And Mitari-san, the former CEO of Canon, said diversification and globalization are the keys to the future, and certainly Canon has embodied that. And it's something to consider, and I think we'll make a fairly compelling case why U.S. investors should consider. And by the way, when I say any of this, it's not to sell you on anything. It's got to be a fit for you, and if it's not a fit, then don't invest. We don't want your money. It's really got to be a fit. And whenever we engage in this conversation, we're talking about the fit between the goals for the project and the goals for the investor. And if that fit isn't there, then absolutely don't invest. So why Canada? I mean, most Western economies, most developed economies in the world, in fact, have demographics where we don't have the fertility rate to even maintain population. Canada's fertility rate is like 1.43, and you need at least 2.1 just to maintain population constant. United States doesn't have the fertility either, but it's being made up through immigration. In Canada, the immigration rate in the United States is running at about 0.4% per year. In Canada, it's 2.4%. Now, it's on a much smaller population base. We're only 40 million people, but we brought in over 2 million, over the last couple of years, we brought in over 2 million people. Last year, we brought in 968,000. First quarter this year brought in 242,000. So again, maintaining that 0.6% per quarter immigration rate. In fact, there was one quarter last year, a 90-day period, where we brought in 1.2% of our total population in a 90-day period, which was an absolute record. So the country is growing, and it sounds strange to say this, but the country is out of housing. We have most major markets with vacancy rates well below 1%, and we have many communities where it's not even a question of affordability. It's become a question of availability at any price. Now, major cities like Ottawa, to a lesser extent Toronto, because Toronto's out of development land, by the way, a lot of communities are, trying to add supply, but we are not keeping pace with the population growth, and it's a real issue. Why Ottawa? It's probably the most stable of all the markets in North America. If you look back over the last 80 years, it has been extremely stable. This has been, the population growth on the top graph here over the last 80 years. It's been consistent. If you look at the pricing for residential real estate, year-over-year home prices, you can see there's only been a couple of points in history where it has dipped below that line. There's really only been 6 years, and I think only 3 or 4 where that decrease has been more than 1%. So it's a really stable market. And where I've circled here, you'll notice that that's 2008. And you might remember something happening in the United States in 2008. Well, it's like it never happened here in Canada, and certainly not in Ottawa. We didn't even feel it at all. So when you think about diversifying and think about, just bringing a little bit of stability to the portfolio, you may want to consider markets that are maybe a little detached from what might be happening in the United States. And we think this is one of them. So where is Ottawa? It's almost due north of New York City. As you continue north on Route 81 up through Binghamton and Syracuse, you'll eventually get to Ottawa. And the property itself is located in Ottawa. The reason Ottawa exists where it does is it's at the confluence of two rivers, the Ottawa River and the Rideau River, and that's why the city exists exactly why it's centered there. That is the actual epicenter of the city where those two rivers meet. And then coming from the north on the Quebec side, there's the Gatineau River, which also comes into the Ottawa River. And so that's why the city is located here. The property itself is in a neighborhood called Westboro. It is just outside the downtown core. Of course, Ottawa being the nation's capital has the federal government as an economic anchor, has a very large tech sector as well as an economic anchor. Household names like Shopify. If you've ever made an online purchase, chances are, even on Amazon, chances are very high that the online store associated with that purchase had Shopify behind it. And then, of course, other major well-known names that some of which are gone now. Nortel was based here in Ottawa. The R&D headquarters of Nortel, which is where I worked, where I started my career, was based here, and numerous other tech companies have a very strong presence here. This particular property is located on Richmond Road, and it's one of the arterial main streets of the city. There's lots of shops, restaurants. You can see the large rectangle to the bottom of the screen. That's actually a superstore, supermarket. There's also a wine store there. There's another supermarket a block away. So there's tons of retail in the immediate area. It's a very walkable part of the city, a very desirable part of the city. One of the things that we did when we first looked at this project, Matt Maxim and our team literally door knocked the entire neighborhood and hit the neighboring area called Hintonburg. And the story was consistent. Nobody wanted to sell their house. And when asked why, they said, well, if I sell, then I have to leave because there's nowhere for me to go. And a lot of the product that's being built in the area is really very like micro apartments, even very, very small apartments. And if you're downsizing from a detached home, that's not the right product for you. So really folks are looking for a different product. And so we looked at the market, saw what others were doing, and came up with a design concept that we felt would be differentiated in the marketplace. The property itself is an assembly of 3 parcels, and it wraps around the corner. So it's a little over, just about a half an acre of land approximately, and so resulting in an L-shaped building. And we'll go into some of the details of the building itself once we go a little further in the presentation. So as always, real estate is hyper-local. You want to be thinking, doesn't mean you have to invest within a 10-minute radius of your house. You want to live where you want to live and invest where the numbers make sense. But the conditions that make a project work in this neighborhood are hyper local to this neighborhood. What applies here doesn't apply, 5 miles away. It's a completely different set of market conditions. So this is an area where people don't sell, property values are high. It's a very desirable neighborhood. Within a block, you've got several restaurants. You've got 2 major supermarkets. You have 2 sporting goods stores within a very short radius. Lots of little clothing shops. Just a very, very walkable art galleries. Very walkable part of the city and one of the most desirable areas. When you design a new product in the marketplace, we believe that the amenities arms race is alive and well. And that means paying very close attention to what the market is demanding. For one thing, there is a shortage of parking. There's a lot of buildings that are being built today that are adjacent to public transit with a very low parking ratio, like 0.5. In some cases, a parking ratio of 0. They're just assuming that people will take the light rail or take the bus. And that's not necessarily true. I mean, think about it. If a single person maybe is taking the train to get to work, and then they get in a relationship and that person has a car, well, they either have to ditch the relationship or they have to move. Those are their choices if there isn't parking available. So parking it's not a real big profit center. Even if you're charging $225 a month for parking, you're still actually losing money on the parking. Not much, but you're losing a little bit of money. The parking is being subsidized by the rest of the building. We believe that today about 7-8% of vehicle sales are electric vehicles. Total penetration in the marketplace around 1% and growing. We believe that EV charging is going to be required. And it blows my mind the number of new buildings that are going up today that don't have that forethought. And when I say that, it's not just about running a wire. EV charging consumes a tremendous amount of power. I mean, a tremendous amount of power. So if you're going to provision a large amount of EV charging, you actually have to increase the transformer vault for the building. A transformer is a fire hazard, so it is actually encased in a concrete bunker called a transformer vault, and that's of a fixed size. So if you didn't size the transformer vault to be 50% larger or 70% larger to handle EV charging, you're not going to have the flexibility to add it, except for maybe a couple of shared parking spaces. And it just blows my mind that developers are not thinking that far ahead in provisioning it in the building. So we've increased the transformer vault. We're putting in larger transformers. We're not necessarily going to pull wire to every parking space, but we're pulling conduit to every second parking space so that if that resident wants to provision EV charging for their own vehicle, it's as simple as pulling a wire and adding the charger, mounting the charger on the wall. So we're roughing in every single parking space and, of course, provisioning initially a number of shared parking spaces. E-commerce delivery, one of those things that's easy to do, but again, you have to think about it. So we're talking about secure delivery lockers accessible from the unsecured portion of the lobby, and these are both dry, heated, and refrigerated. So depending on what it is that you ordered, your food can remain hot, your food could stay cold, or if it's just a regular dry package, then it will go in a dry locker. And these lockers are programmable. So it's not like this bank of lockers over here are refrigerated and that bank of lockers over there are hot. It's on a locker by locker basis, and it's a great product. So it's one of the things we're including. And you have the usual things that you would expect to see, like the fitness center, the party room, the pet spa, all of that sort of thing. But the business center is an important amenity that not a lot of buildings have. If you work from home and you want to have a meeting and you need a conference room and you don't want to necessarily meet with a client up in your apartment, having a meeting room, a shared meeting room that you can book is an important amenity. So we've included that as well. This is a mixed-use building, of course, being on an arterial main street. The storefronts are retail. It is a retail storefront situation with a residential lobby, so it's absolutely a mixed-use building. We are in discussions with several tenants. Rents in the area on a triple net basis are ranging between $35 and $45 a square foot triple net. And this particular bakery is a gentleman from France who got stranded in Canada during the pandemic, fell in love with a Canadian girl and had nothing to do, so he opened a bakery, and they're doing a bang-up business in a terrible location. So we're in discussions with them about them actually setting up a ghost kitchen bakery that would service several retail locations, including this one in our building on Richmond Road. Ottawa is not an easy place to build. Supply is restricted, in fact, quite a bit by zoning. Government has been trying to relax the zoning, approve increased density. They've made some attempts at streamlining the approval process that, quite frankly, have failed. So the provincial government implemented some changes to theoretically speed up the process. And then in the last month, they reversed most of those changes. So they've gone back to the old process, but really haven't sped things up. So one of the, because Ottawa is a difficult place to build, that is absolutely a barrier to entry. There's no question. And that is an advantage for those who have gone through the pain and anguish of that process. That means us, to the point where we now have an approved project. And so, that barrier for entry is for the other folks that are behind us in the marketplace. We are not speculators. We don't like to speculate on what the market could do, might do. And so we've based our financial model on things that are happening in the market. And I'm referencing specifically 236 Richmond Road, which is the building across the street that was designed by Vince Kalitza, built by John Bassey. You can see here too, they have ground level retail. It's a mixed use building, and we're basically copying their rents. We're taking a proven model that is, demonstrated to work in the marketplace, and essentially just copying it and doing it better. That's it. There's no rocket science here. It's simply copying a proven formula. So one of the things that we did, this project started out, if I go way back to its inception, it started out actually as a condo building with 87 units. And then we realized that the condo market was not as robust as we thought originally. We turned it into a rental building at 104 units. And it's no secret that it's a difficult environment for real estate, North America wide. The rise in interest rates has challenged a lot of apartment owners. It's challenged a lot of developers. In fact, a lot of development projects have been canceled because of the increase in interest rates, because of the increase in construction cost. A lot of headwinds that have really hampered development as a whole. And there was a point in time where we were looking at the numbers and saying, boy, this really is not working as well as when we started the project. And we came to the conclusion that we needed to do something different. So we have redesigned the building again in its entirety, brought it up to 137 units. We reduced the total square footage from 127,000 square feet above ground to 115,000. But we actually did not reduce the rentable area, which is, you think about it as just the building's more efficient. We started working with a different architect, the Ottawa's premier architect, on this revised concept for the building. And he was able to increase, for example, the efficiency of the parking. And I'll take you through some of these details. And I think it's important for you to know that we're a team that is going to fight for our investors. So if things are not working to the point where we'd like them to be, we will make difficult decisions. And I can tell you, it's a difficult decision to change the building design from something that we thought that we really liked. I mean, there were a lot of really tremendous advantages to the building that we had designed, but there was a drawback, and that's that the numbers weren't working, at least not to the level that we thought investors wanted to see. In fact, not even to the level that we had committed previously to investors. So we wanted to rectify that. So we made the difficult decision to redesign the building. So this is the current rent forecast. Again, it's based on proven comps, things that are happening literally across the street, around the corner. We're not speculating. So it's we've increased the unit count. We've increased the income associated with the building. As a result, some of the smaller units are more efficient. You get higher rent on a per square foot basis. And so overall, it's a better performing project. This is a little bit of an eye chart, and no surprise, we forecasted out beyond just the first several years. We want to see how the project's going to perform over the long term. One of the things that happens in an inflationary environment is, of course, rents go up and so do expenses. But over time, rents, basically the profit margin increases over time is what happens, because rent, or the expenses are only a fraction of the rent. So even if they're going up in concert with the rent, the profit is increasing year over year. And that's exactly what happens here as well. This is 3 images that detail some of the changes that we made in the building's design. The original design of the building had the parking entering partway through the middle of the building on the right-hand side, and we moved that ramp to the very top. So if you see the image on the left, the very top rectangle on that image on the left, that's the parking ramp. That's the entrance to the parking. And that extends down to the parking garage. We were able to increase the density of the parking from 78 parking spaces on 2 levels to 90, which allowed us to actually reduce the parking from 3 levels to 2. And that alone was worth a couple of $1 million in savings in the overall construction cost. The other thing that we did, I'll show you, if you remember the image of the building. On the north side of the building, it had these beautiful terraces that make for a very lovely, a very attractive building, but they're also very expensive to build. And so we've eliminated some of that square footage in order to increase the efficiency of the building. Again, remember, we did not decrease the rentable area. The rentable area in the building stayed the same, but we changed the form and the shape of the building and to result in a more efficient building design. So as a result of those changes, we intentionally pushed the schedule to the right because we felt that the cost savings associated with this redesign was worth the delay. Right now, we're about $4.5 million in savings as a result of these changes. We have additional savings in our back pocket that we have not availed ourselves of. So we see a path to an additional $2 million in savings through a change in some of the building technologies. We also have been very active in looking at global supply chain, and it's an area that can result in some tremendous savings, in particular for the finishes within the building. In the month of April, I spent a week in Turkey attending a very large builder expo there, and you might say, why Turkey? You would think China would be a better place. And we are active in China as well. But Turkey is a nation that has been experiencing hyperinflation for years, and the quality of their products extremely high. If you're buying in Turkish lira, but actually paying in US dollars or Canadian dollars, it's like the whole country's on sale. It makes a huge difference in the cost of materials. And again, the materials are very, very high quality. Not everything is certified for use in Canada, but then not everything has to be. So for example, ceramic tile doesn't need to be certified for use in Canada. There's many products that are in that category that can result in some fairly significant savings. So we have not booked those savings into the project as of yet. And we're holding them in our back pocket in case we need them. We don't know what headwinds might befall our economy in the future. I mean, who knows? We might have another global pandemic, or who knows what, that we need to adapt to, and we want to make sure that we have the resilience within the project. And so I hope you're getting the message that as a development team, we are thinking ahead. We are, planning for hoping for the best, planning for the worst, so that we have a project that no matter what the economy throws at us will succeed. So the opportunity itself, we're looking to raise a total of $11 million. That's 8.3 million in US dollars, of which we've raised so far just under 6.5. I needed to update that number before the slide went out, but it's just under 6.5 million. So the balance of the raise is about 3.6 million in US dollars. And the total project, this is reduced from what it was. The project was quite a bit more expensive. This is now a $74 million project in Canadian dollars, or 56 million US, that should value at 86.7 million in once it's stabilized. So that gives, think of it like a profit margin or an increase in value of 17% above the project cost, which is healthy. Is very, very healthy. The structure for the investment is as a limited partnership, which means that in any limited partnership, there is a general partner, that's us. There's a limited partner, that's the investor, with 20% of the ownership going to the sponsors of the project. And we've also included a 5% preferred return. And we've defined that as a floor return. I'll just take a second and describe what that is. If, let's say, the cash flow would yield on a profit split basis 7%, well, then you would get 7%. If on the other hand, there wasn't quite enough cash flow and it only yielded 4.9, well, then you would get 5, and you would take the extra from the general partner share. That's how that works. So it's not a guarantee, but it's setting a floor on the rate of return for investors. So that's a good way to think about it. It's our intention to keep the asset for the long term. There is an opportunity baked into the plan for investors to exit early at the 5-year mark if they so choose. So both of those options are available. The financing for the project is based on a product called CMHC's MLI Select program. The Canada Mortgage Housing Corporation is equivalent to Department of Housing and Urban Development in the US. So just like HUD has construction to perm loans for apartments in the US, and we're very familiar with those, of course, Canada has a very similar product. It's not exactly the same. Ours is a 50-year amortization, whereas the U.S. product is a 40-year amortization. It's an assumable loan, so you can sell the building with the loan if you want to. It's a limited recourse loan, and so on. It's really some of the best financing out there, and it is based on an index off of the CMB bond rate with a 35 basis point premium. So today it would price at 3.93%, which is a very attractive interest rate as you compare, if you were to compare that with, let's say, a Fannie Mae loan that today might be pricing in the high 6s to low 7s. The financing is extremely attractive. So let's talk about sources and uses. Where's the money coming from? Where is it going? So total project cost is 74 million Canadian dollars, 56 US, 11 million of that in equity, 63 in construction debt through the CMHC MLI Select program. We do have the option of financing conventional and then refinancing into CMHC. And we're looking at both those options right now. I would say staying with CMHC from inception, cradle to grave would be the way to go based on all of our analysis. Where's the money going? 12% into the land, 14.6% into soft costs. The reason the soft costs are that high is there's a lot of taxes. There's a lot of development charges or impact fees that we have to pay. And those are the biggest components of that number by far. Things like architecture and engineering is still a small share of the total soft costs. The hard costs at around $315 per square foot for the above ground and $150 a square foot for the underground structured parking. We've loaded up the project with a pretty healthy set of reserves, and that breaks down into interest reserves, contingency funds for the possibility, although we don't think so, of cost overruns in construction, as well as a contingency for what we call initial operating deficit. So if the building were to take longer to lease up, there's a pot of money, a contingency fund to fund that as well over and above the interest reserve. There's about 2% of the project development cost. 1.4% of the project development cost in fees, development fees. No one's getting rich off of that. It's there to hire the staff, to pay the cost of that additional staff required to implement a successful project. And so that's where the money is being spent. From a rate of return perspective, this is our forecast. We expect the internal rate of return to be around 20-ish%, low 20s, depending on when you exit the project. If you exit at the 5-year mark, it's just above 20%. If you hold it for the long term, it drops a little bit simply because time extends. So that has the effect of lowering the rate of return. But then, of course, the amount of money that you make, if you keep your, stay in the investment longer, goes up. So the equity multiple goes up by quite a bit by staying in longer. So we always look at those IRR metrics. When we talk about headwinds in the market, of course, interest rates is one of the biggest variables. We believe that interest rates have peaked. I don't know what your crystal ball says, but our crystal ball says they've peaked. We've seen the Bank of Canada cut rates by a quarter point in the last month, and so we have based the metrics on the current commercial bond rate, the mortgage bond rate of 3.58, which would result, if we were to rate lock today, in an interest rate with CMHC of 3.93%. So to give you a sense for what that looks like, if interest rates were to drop, say, another quarter point, then the IRR to investors would go from 20.7%. From 20.5% to 20.7%. So a quarter point decrease in interest rates roughly translates into 20 basis points increase in the rate of return to investors over the life of the project. If interest rates were to drop by half a point, then we'd be looking at an IRR going to 21%, so a little bit higher. And then if we were to go the other way, then if interest rates went up by a quarter point, then the IRR would reduce to 20.2%. So that gives you a sense for, the impact of interest rates on rate of return over the life of the project. In terms of how the project is organized, this is set up as a limited partnership. We have several folks in the general partner group. There's JB Holdings, which is John Bassey. There's Copper Beach, which is Matt Piceni. There's Y Street Capital, which is myself and the other partners that are with us here today. And then 80% of the ownership of the project goes to the limited partners or the investors. So that goes into a limited partnership entity. As a subsidiary, there's a corporation. It's a numbered company. I forget even the name of the company at the moment. And it holds the land, and it's a wholly owned subsidiary of the limited partnership. All three parcels are owned by that one entity. And so, in fact, they are no longer separate parcels. They have been consolidated into a single parcel, as is required under the Planning Act. So that's the basic structure. The general contractor is John Bassey over on the left-hand side with a contractual relationship to his development company, and then another contractual relationship to our development management company to manage the development on behalf of Y Street Capital. We think that this is a fairly tax-efficient structure for those that are looking to invest, in particular from the United States. It's tax-efficient certainly for Canadians as well. There is a requirement for non-resident withholding tax on the net income after expenses. Depending on how the income is classified, determines the amount of withholding. And now and by the way, we're not here to provide tax advice. So everyone's circumstances are unique. You definitely want to talk to your CPA and make sure that they're in agreement with everything that we're saying here. But there is a tax treaty between the United States and Canada, and the purpose of that tax treaty is to prevent double taxation. That's why it exists. And so whatever is paid as a non-resident withholding tax in Canada, you would then take as a tax credit against your tax owing in the United States. So it's not a deduction, it's a tax credit. You want to make that distinction so it's very, very clear. Now, of course, there is, whenever you're making a foreign investment, the question of foreign exchange. And foreign exchange rates do fluctuate. Sometimes they go up, sometimes they go down. So there is the possibility of either a foreign exchange gain or a foreign exchange loss over and above the investment itself. Okay. So I guess really the question is this for you? We really think this is for accredited investors. And if in fact you're a U.S. investor, that's a requirement to invest. This is being governed by Regulation D506C exemption under Securities and Exchange Commission regulations. And so we would require you to be an accredited investor. If you're looking for an investment that is cash flow focused, it's not going to cash flow a ton in the first year or two, but once it's built, it's going to generate decent cash flow. If you're looking for a tax efficient structure, in particular, looking for a stable environment and for geographic diversification, this might be a fit for you. So we'd encourage you to look at it deeper if it's a fit for you. We do go through a process of verifying that investors are accredited. We actually work with a third party called Parallel Markets. And so you don't have to send us all your tax returns and all of that information. You don't need to worry about that. You can upload the documents. This is all this company does, is they do verification of accreditation. So you upload the documents and then they generate a letter saying, yes, this investor is accredited. As an alternate, you could have your accountant or your lawyer or a registered investment advisor who's registered with FINRA or the SEC provide a letter, essentially a letter saying that you are accredited. Or you may have an existing accreditation certificate from a previous investment. It says here 90 days. I think those accreditation letters are now valid for quite a bit longer than just the 90 days. So I think the SEC rules have changed. So those are the options. So if you think this might be of interest to you, you definitely want to send an email. I'll put the email in the chat window. Send an email to Victor M at ystreetcapital.com. That's Victor M at ystreetcapital.com. And at this point, we'll open it to questions. So if you have questions, You should be able to put those in the chat window, and I should be able to get your questions. So, question from Anthony: U.S. investors can invest in Canada? Yes, the answer is yes, absolutely. What is the exit strategy from Pradeep on completion of construction and lease up? So we don't really intend to exit per se. We intend to hold the asset for the long term. Now, there is an opportunity to do a buyout at the year 5 mark. And so there's a formula for that. And so that is an exit. It can't be for everybody because then that essentially means selling the project. But if there are a small number of folks that want to exit at that point, that will be an option. The other option exists at the 5-year mark with the CMHC financing. These loans are on a 5-year term. So what that allows for is essentially a refinance at year 5 of the loan term. So there's potentially a partial repayment of capital at that point in time. Question from Michael: when are we expecting the distribution period to begin? That'll be at stabilization. So once the building gets leased up, we will build a little bit of cash so we have a minimum amount of operating reserves. So that's, and then at that point, any dollars in excess of reserves would be distributed to investors. Next, from Andy: do Canadian investors need to invest in US dollars? No, of course not. That would be an unnecessary, unnecessary exchange of dollars. The project's in Canada. It's being built in Canadian dollars. We tend to talk both Canadian and US dollars because we are so active in the United States. We have, in fact, the majority of our investor ecosystem is US based. We're active in 9 states in the US. So we speak US as much as we speak Canadian, even though we have quite a few projects in Canada. And then from Eve, asking the definition of accredited investor. So it's someone with a net worth of $1 million. The US and Canadian definitions are slightly different. In the US, it's having a net worth of $1 million, excluding your principal residence. In Canada, there is no such restriction. It is that definition is based on the Securities Commission that has jurisdiction. So in the case of Ontario, the Ontario Securities Commission has their definition as well for accredited investor. So we can make that available as well. So I think those are, let me just see if there's more questions here. So far, those are all the questions. These are easy questions. Hit me with some hard questions. So from Pradeep: are there other changes or uncertainties remaining with regards to changes in design, permitting, or other potential entitlement issues? That's a great question. So when we completed the zoning, so the zone, let's talk about the permitting process. So the most stringent level of permitting would require a change to the official plan of the city. We did not do that. We did not require any change to the official plan. So we were building by right as far as that goes. Then the question comes of zoning. So we did seek a zoning amendment. That zoning amendment was approved by City Council. So we are zoned. We are fully entitled to build the building. So we don't need to go back to council and get a vote or anything like that. That's all done. The next piece is something called site plan approval. We are deep into that process right now. That's an administrative process. that simply says that the building complies with the zoning. So they want to make sure that the actual build form that is proposed is going to comply, within the building envelope of the zoning. And there's a few additional criteria, but it's strictly administrative. And there is a planner within the city that's assigned to that. So we're, very close to completing that step. And then finally, the last step is the actual building permit itself, which means, do the drawings comply with the building code? So we don't believe that there is risk associated with either of those two steps. We're not concerned about that at all. In fact, the province of Ontario issued a new variant of the building code, on the Ontario Building Code, in March of this year, with close to 2,000 changes to the code, many of them designed to relax and simplify the building code, make it easier and quicker for folks like us to build. So we've reviewed those changes. There's nothing there that has us worried. So we don't see risk on the horizon as far as that is concerned. More questions? Going once, going twice. So let me put my email address in the notes here. And actually, I said this a little bit incorrectly here. So what makes the most sense, if you go to ystreetcapital.com, we have an investor portal. So if you go to ystreetcapital.com and you click on the investors, there's a place. If you're not already registered in our investor portal, it's a very simple form to register for the investor portal, and that will give you access to this project. There's a complete data room associated with this project, and the simplest way to seek more information, to start a dialogue with us, is to go in there and type invest. You push the button, the big button that says invest, and put in whatever number makes sense for you. There is a minimum investment associated with this project. It is 100,000 Canadian or 75,000 US. We have been known to relax that on occasion. So if you can't do 100 Canadian or 75 US, come have a discussion with us. We can see if there is some flexibility there. If you're only looking to do 10,000, it's probably not a fit. I'm just going to say here, because if you are in fact an accredited investor, then almost by definition, you've got additional means than more means than the average person. So there, a project of this size, 100,000 is minimum investment. What else can I tell you? So yes, definitely go to ystreetcapital.com, enter our investor portal, and then of course there's an opportunity to ask any questions of us. We can jump on a Zoom call with you, and all of the documents are in the data room directly, so you can see everything associated with the project in the data room, and you can conduct your own due diligence on us and on the project. Okay. And then of course, feel free to email me as well if you have any questions. Okay. So if there are no further questions, we'll say going once, going twice. If there's no further questions, there's one more question. Is there an option to invest any self-directed IRA funds? We don't recommend it. We don't think self-directed IRA is the best option, and it's for reasons of tax, because whether you invested in an IRA or with your own personal funds, by virtue of being non-resident, there would be still the distributions would be subject to a non-resident withholding tax. Now, you could get a tax credit against that non-resident withholding tax, but if it's going into a self-directed IRA, there's no tax owing, so you can't do anything with the credit. So you would essentially be using funds that are tax sheltered and paying tax on them, which is not a great move. So we would not recommend using IRA funds in for cross-border taxation purposes. Okay, that's a very good question. Any more questions? Going once, going twice. And if you think of a question that as soon as we hang up, just feel free to email me. It's at victorm@ystreetcapital.com. Thanks, everybody. Have a great night.